Hello and welcome to another video on my YouTube channel. My name is Joris and today I am here with a video that I worked actually quite a long time on, and it's my Fortress Playbook, a timeless strategy for building generational wealth. And I made it with the help from Notebook LM, in which I let it compile all my videos that I made so far for my YouTube channel about saving, budgeting and investing. So it's a video that I'm making especially for my kids, but also for you. So I hope you have something after watching this video to get you started on your own journey of investing and building your generational wealth. And if you like this kind of videos, please hit that subscribe button and follow along for my investing journey. First off, do not buy lottery tickets, but build a fortress. A lot of people, they want to attain the dream of instant wealth and play the lottery. Here in Switzerland, you have the Swiss lows, you have Euro Millions, you have Euro Dreams. A lot of people play that, but take the Swiss Lotto. You have a chance of 1 in 31 million and a bit of winning the jackpot. And on average, you will have a loss if you play twice weekly with a full set of numbers of approximately 1,280 Swiss francs per year. So that's a huge amount for a lot of people, but still they don't realize how much money they are actually spending on trying to win the jackpot. And on the other hand, you have the Swiss market index here in Switzerland, and that brought 8.40% on average as an annual return for the past 25 and a half years. So long-term compounding and growth and turning contributions into substantial wealth over time, that is the goal where you should be aiming your money towards and not short-term gain. So the first principle which you have to obey to is fortify your foundation, and you need to know for sure that your fortress isn't built on sand. And for knowing that, you need to know your cash flow. Budgeting is crucial because if you don't know what is coming in and what is going out, you don't know how much you can save and put aside that you can really invest, because you can't invest money that you need in order to live. So a lot of mistakes are made like that. A lot of people, they start investing way too much and then they need the money, the market went down and they need to sell with a loss, and then they say, hey, the stock market, it's really a scam. I lost a lot of money there, but actually it's their own fault. And then after you start saving, you can first or have to build an emergency fund. So establish a safety net of 3 to 6 months of living expenses in a separate, easily accessible bank account. And after that, you can start investing. You know, I combined it a bit. I built my emergency fund and also start saving. That's because my wife and I, we earn enough money to do that. And we also have a strict budgeting routine. And in that regard, here I say automate your discipline and pay yourself first. We always pay ourselves first, but the automatically part, so the automatically transfer, with me, it's not completely like that. I wake up on the morning of the day that we receive our wage, and the first thing I do is log into my banking app and I transfer the money to our investing account. And then there I receive the money and then I invest it as quickly as possible into the ETFs that I agreed upon with my wife, with our core satellite strategy that we agreed upon. But if you obey this principle, this ensures that you will invest consistently before you will do other expenses, and that this can consume your savings before you actually start investing. So really important principle. Then you have the second principle, and there you have to master your psychology, because on the stock market, you are your own worst enemy. So you have fear, you have greed and impatience, and those will lead to poor decisions. So you have to get a grip of yourself. And the prudent investor masters their emotions to protect their capital. Just be aware of loss aversion. So the pain of losing is psychology more powerful than the pressure of gaining. So this causes investors to hold on to losing positions for far too long and sell winners too early. And on the other hand, you have the other thing, and that is realized versus unrealized losses. You haven't realized a loss until you have sold. So that's quite difficult thing to distinguish between loss aversion. So you need to sell in order to protect your capital. But on the other hand, you don't want to sell too quickly. So you need to know in what you invest in order to be able to withstand the temptation of selling a stock that is down for the short term. If you invest for the long term, you need to be able to see red numbers as well in your account. But on the other hand, you don't want that loss. So you really need to master your psychology and know how you invest before you go and jump into it. And then you also know percentages can lie, but numbers do not. A lot of people, they go and watch YouTube videos of people that say, hey, I made 90% profit on that stock. But what they don't tell you is that that 90% was made after they already lost 90% on that stock. And if you look at their total gain, then it's still a 81% loss. And they are not going to tell that on YouTube because they are not honest people. And you have to look beyond that. So my YouTube channel, I show everything. I show my buys, I show my sells. Yeah, I only made one sell so far, so it's not not a big secret that I'm a buy and hold investor, but you get the picture. Don't believe everything that you see online, especially on YouTube. And yeah, I'm a YouTuber myself, but I think that my strategy makes sense and it will make sense to you as well. Then you have the third principle, and that is adopt a value-driven strategy. And you will see that when you look at this, it reflects the theory of Warren Buffett greatly. So you have to understand the business. Then you have to look for a durable moat. And I asked Notebook LM to take the image of a castle surrounded by a moat that protects the castle, and it did that. It screwed up the arrows a bit, but I hope that I corrected it completely. So you know what the intrinsic value of your castle is worth. So you want to have a margin of safety, because a margin of safety is crucial, that you buy below the intrinsic value that you calculated. So then you have a range of prices where you can buy the great business. And yeah, most of the time for me, it's a PE below 18. For banks, ENG, it's below 10. And you can follow that on my U portfolio. So if you're interested, you can go and check out my playlist of my U portfolio. And the goal is to purchase great companies at a fair price based on their fundamental value and not their market sentiment. And then you have the fourth principle, fuel your growth with dividends. And you know that I'm a dividend investor. I like receiving dividends because it's my motivation for patience. So receiving regular cash payments keeps me motivated to stay invested and also to keep investing more and more. And for me, when a company pays out dividends, it's a proof of health. So a consistent rising dividend is a strong signal of a stable, profitable company. And I aim always at a payout ratio below 60% because this indicates that the dividend is most of the time sustainable, but you know that this is dependent on the industry of the company where you are investing in. REITs are a completely different story. Yeah, it's also consumer goods companies. They are completely different. They are way beyond the 60% payout ratio. But most of the time, you know that those companies can maintain their dividend because they are already doing it for 20, 30, 40, 50 years. Coca-Cola is even doing it for over 60 years. So yeah, it's a fuel for compounding. So reinvesting your dividends then will allow you to buy more shares, which in turn will generate more dividends, creating an unstoppable growth cycle. And you know my rule of 300. This is a depiction of it. So with every 300 Swiss francs you invest, you are giving yourself a permanent recurring pay raise. And that's also my main argument about the fact that a lot of people complain that on dividends you need to pay taxes. Yeah, but when you give yourself a pay raise or when you get yourself a pay raise from your boss, you're also going to need to pay taxes on that pay raise. Here you're giving it to yourself, and in that way I can live with the taxes. I don't say that I'm agreeing with the fact that you need to pay taxes on dividends because the profit that is being paid out to you by the company is already taxed. So I don't like that at all. So you also get taxed on, yeah, it's sometimes double taxed when you buy companies in countries where you already have a withholding tax withheld. And then you have also a withholding tax in your own country. Here in Switzerland, it's 35%. So when you buy some things from France, where it's 30%, and then another 35% here in Switzerland, you are taxed crazy. With ETFs, when you buy from Ireland, there is no withholding tax before you receive it. So that's actually one of the best options. You have other options as well where you are not taxed from England. When you buy companies from England, there is no tax as well. So you will receive in Switzerland the whole dividend amount, and then you will need to, yeah, put everything into your tax return, and you will be taxed like that. And then the eighth wonder of the world, of course, it's compound interest. He who understands it earns it. He who doesn't pays it. That's a saying from supposedly from Albert Einstein. Whether or not it's actually true, I don't know. I haven't seen anything about that in his writings. There was an exposition, and there is still an exposition of Albert Einstein here in Switzerland, because he lived for a long time here in Switzerland, and it was a really interesting, yeah, exposition. And there wasn't a page open on where he wrote in a letter that compound interest is the eighth wonder of the world, but it's, yeah, it's a nice example of how important compound interest actually is. And here you can see that from a certain point in time, here it says around 16 years, but it can be later, for sure it can be later, but there will come a time, a point in time where you will get more dividends from your investments than the amount that you're actually investing. We are really close of reaching 300 Swiss francs per month, and that's the amount where we started with. Now we are at 900 Swiss francs per month, and it will be more or less 10 years before we reach that state. But just remember, we increased our contributions as well, so it's not completely correct. But from the moment that that happens, yeah, then you will see that your money starts working harder for you, and that's the moment that you realize that you are really building something for the future. And that future thing is your fortress, and then you need to think about the fifth principle, and that is how to choose your building blocks. And in this, my wife and I, we chose the core satellite strategy, and there the core is the foundation, and that's 60 to 80% ETFs. We are at 80% ETFs, and an ETF is an exchange traded fund. So it's an investment that holds a diversified basket of hundreds of thousands of stocks. So not 100,000, but hundreds to thousand numbers of stocks, because it follows an index, and they provide a stable, low-cost, broadly diversified core for your portfolio. This is your first and most important building block. And then you can go to individual stocks or also individual ETFs that you like, and those will make up then 20 to 40% of your portfolio. And this will give you ownership in a single specific company, and it's for targeted investments in high conviction companies after your core foundation is firmly established. And I put after between parentheses or asterisks, because for me it's not actually needed that you build it after. You can build it on the same time. So you can say, okay, I have 1,000 Swiss francs to my disposal for investing every month. Then you can say, I will invest 800 Swiss francs towards those ETFs as my core, and I will invest 20% towards those stocks, and only buy the stocks that are, in your opinion, on that time, the most or the best buys at that moment. So you can do it afterwards, but you can do it at the same time as well. And then you need to know what you own. So I want to point out the risk of synthetic ETFs. When you buy a physical ETF, you have direct ownership of what you are buying. So when you buy a physical ETF that says that it invests in Nestle, Roche, Novartis, and Clariant and everything, then you really own those shares in the percentage that is noted on just ETF or on the site of the provider of the ETF. With a synthetic ETF, it's actually a counterparty promise. So you think you are investing into these companies, but in fact, your counterparty bank, it promises you to deliver the returns of these companies, but they actually sell something else to the investor. And this is risky because when the counterparty fails, you are exposed to significant potential losses. So the rule for me is prioritize physical, full replication or sampling ETFs to ensure that you truly own what you think you own. And then on the other hand, you have bond ETFs. And you know, my philosophy is I don't go for bond ETFs, I go for stock ETFs. Why? Because when you have bonds ETFs, it can be that other people panic, and then the fund manager needs to sell those ETFs which contain the bonds, and they have to sell the bonds, and this makes a forced sales loss. So it is because of the market volatility that the ETF fluctuates forever based on market sentiment, and when people then panic, yeah, you are actually taking the loss as an investor in those bond ETFs. Compared to owning the bonds yourself, where you yourself have the ability to hold on to that bond and then sell the bond at full value at maturity. So when you know what you buy, when you do want to buy bonds and you buy the bonds yourself, then you have more control than when you buy bond ETFs. That's why I'm not a big fan of bond ETFs. And on the other hand, I'm not buying bonds either because the market makes the government. So I think that when you believe in a certain company, that you shouldn't buy a company bond, but buy the stock of the company. And if you then look at the market overall, why would you buy a government bond when the market makes the government? So it doesn't make any sense to buy a government bond. Just buy the stocks of the companies that you believe in. I hope this is clear. So I'm not an advocate of buying bond ETFs. And also, even if I get older and closer to my pension age, I'm not going to reduce the number of stock ETFs in my portfolio and switch to bond ETFs or a higher percentage of bond ETFs. The percentage of bond ETFs will always be 0% in my portfolio. The percentage of bonds in my portfolio will always be 0%. And then you have the sixth principle. So execute with unwavering discipline. A brilliant strategy is useless without disciplined execution. So follow these steps consistently to build your fortress brick by brick. So make a plan. Confirm your budget, emergency fund, and risk profile, and decide on your decide on your core satellite allocation. Once you have that blueprint, go and choose your broker. I'm not a good YouTube channel for that. I have Swissquote and I have you. You is cheap, but you have low amount of choices for things to invest towards. Swissquote is excellent for having a broad range of selections, but it's actually not the cheapest one around. We took it because it's a reliable Swiss broker, and you can go for other brokers. Go to the website of the Poor Swiss for that. He has a lot of articles about brokerages in Europe, in Switzerland. So yeah, way better information than my YouTube channel. When it's like that, it's like that. Then you have to deposit and invest consistently. So if you can do it with automation, do that. But just make sure that you have a regular schedule and do it right after you get paid. So pay yourself first. Then when you get dividends, reinvest them all as long as possible. So I would do it until you retire and you need to live off your dividends. But still, when you do that, you have the rule of 300 that says that you can live off your dividends for the rest of your life without needing to sell your shares. And that's really crucial. Not needing to sell your shares makes that this is really truly generational wealth. And then track and stay the course. So monitor your progress, celebrate milestones, even reaching 10 Swiss francs per month in dividends. It's a small victory. Go and celebrate. Go buy yourself a Coke. If you are an investor in Coke or McDonald's, go and get yourself a McDonald's meal. You know that you invest the money in a company where you have your own money invested towards. So yeah, it's I not invest, it's spend your money when you go and eat in McDonald's, of course. But you get the picture. Celebrate small victories and resist the urge to change your strategy based on market noise. So during the down period from 2000 till 2013, the dividend strategy was the best strategy that you could follow. From then, 2010 actually to now 2026, dividend investing, it still brought a lot of returns. But when you look at the tech stocks returns, they way outperformed the dividend strategy. That's just the way it is. You need to know how to learn to live with that. So master your psychology, another thing that I already mentioned. And in this regard, you need to know the unbeatable rhythm of consistent cost averaging, CCA. There is only CCA. I'm not going to go into this further. I always mention it. Consistent cost averaging is the way to go. I hate dollar cost averaging because it has dollar in it. Euro cost averaging and everything, it's all bullshit. Just go for consistent cost averaging. You can do it with every currency that you need. The thing is, time in the market is infinitely more powerful than timing the market. So just keep investing consistently. Then Principle 7, read the market's temperature. And there I have the graph of the Shiller PE. Okay, it's already a bit dated because it moved a bit, but it's still a good depiction of how you should read the market in order to know whether or not the market is expensive or that it is actually a market full of opportunities. And right now you need to know that the market is quite expensive. So just know that the market can come down any moment. But if you then do CCA, you are set for life because you will pick up more shares on the way down. And then the final act, knowing when to sell. Once again, these are also the three principles that Warren Buffett applies when he wants to sell. So certainly sell when you know that the thesis about the company that you bought into is wrong. So when you find that out, when the fact changes, make up your mind and sell the stock. Because when the thesis isn't there anymore and you do hang on and it goes tumbling down, you know that you made the mistake of not adhering to the first thing that I'm telling here for this slide. And then the second thing is when the price is irrational. So when the price is way bigger than the actual value of the company, you can decide to sell. But in this place, I also want to make a connotation. When you know that a company is actually quite good and it's a compounding machine, like Joseph Carson always says, when you know that it's just temporary and you can live with the drop down of 20% and then go for owning the company another 10 years where it's going to rise for another 200, 300, 500%, then I would just hold on to the stock because a good compounding company, it can be that you sell and then it goes down 10, 15% and you still think, okay, it's still a bit overpriced. So it doesn't come down the complete 20% that you thought that it was going to do. And then you miss out on buying back in opportunity. And then you miss out on the next journey up of that compounding machine. So think wisely and truly decide when the price is actually irrational, with the fact that a compounding machine is actually a great thing to have in your portfolio. And then you have the third option, and as you know in the video that I made about this, it's really difficult, this third point, to know whether or not you are correct. So you never know whether or not a better opportunity exists until you actually do it and it comes true. Sometimes you make the right decisions, sometimes you make the bad decisions. You have to make up your mind then and stick to your decision, because as I said in my video about selling MRIs, in hindsight, everybody is right and everybody is wrong. It is, you make a decision and you make a decision on that time with the knowledge that you have on that time. And when you believe at that time that it's the right decision, you shouldn't look back. The only way that you should look back is to know whether or not you have to change your rules for in the future. But on that time, with your current knowledge, you made the right decision and you have to learn to live with that as well. And selling is the most difficult thing in when it comes to investing. So knowing when to sell, this slide is actually really, really, really important. And then I want to finish this video off with, it's the long game. So true wealth is not an event, it is a process. It is the result of a sound philosophy, unwavering discipline, and the patience to let compounding work its magic. You have the blueprint now, so now go build your fortress. It is meant to last for generations. Thank you for watching to this video. I hope you enjoyed it, and see you on the next one on my YouTube channel. Bye.